Lyn, thanks so much for taking the time to chat with us today. I early on when everything started with COVID, I found myself worrying about everything that's happening economically, following monetary policy. So I turned to YouTube, and I started watching all the different characters that I normally turn to, and then I noticed I came across your content. I started reading your blog and was just sort of so thought provoking that it literally almost frees my mind with different thoughts when I'd go through the content. And just sort of seeing how you've sort of exploded on the scene here. I mean, you've kind of gone from really not being that well known to, well, you now have almost a couple 100,000 followers on Twitter, a huge YouTube following. But what I find interesting about it is you're not like a lot of the other sort of personalities that have blown up that are usually all doom and gloom, and we're facing a hyperinflationary event. You're kind of more of a thoughtful, common sense approach. Why do you think it is that you've resonated so well with people who love economics and enjoy sort of monetary commentary?
It's hard to say for sure because if I knew the exact recipe, I would really, be able to focus on that. But I guess, just trying to be genuine and trying to look at the numbers and then just kind of, go out from there. And so, if you look at, tutorials on like, how to do online content, usually they're like, okay, keep it short, keep it sweet, write simple. And I just kind of threw that out and said, well, I'm going to write 8,000 word posts with like 25 charts because that's the kind of content I want to write. And I get questions in emails, and I got to the point where I can't answer them all, but they give me ideas of what to write about. So if I see a common topic pop up, it's usually also something I'm curious about. Like there's some quirk in data that I want to look into, or there's some topic that I want to make sure I understand how it works. So I'll spend a lot of time researching something and then lay out this article that's almost like a paper, and it's something that people can then, it's kind of ends up being like a de facto guide on that topic that sticks with people. They don't just read it and then forget about it. They remember that, they go back and look at it again, and so those like kind of foundational pieces of content that really kind of stick around. And so, there's that market for that more like loud kind of doom and gloom outlook, and that can get a lot of short-term interest. But if you're always doom and gloom and then the doom and gloom never comes, or it comes in a much different way than you're expecting, then people kind of start tuning that out. It becomes more noise. If you're just trying to look at the nuance, I think it goes a lot further. It's also the fact that my audience is split between retail investors and more professional or institutional investors. And so one of my goals is to kind of take institutional level research, but then make it accessible, which benefits both retail investors and those institutional investors as well.
Okay, so let's get into some of your recent research and pieces. So one of the things that you recently came out with was sort of a look into sort of these U.S. structural trade deficits, and how those dollars that get spent for those trade deficits then end up getting reinvested into U.S. equities and real estate in the U.S. What risk do you think that this poses for the U.S. economy and U.S. dollar? And then secondly, do you think that this puts the U.S. in a situation where they have to keep creating investment products that the rest of the world wants to invest in?
That's kind of the trap that they've gotten themselves into. And so basically, every 50 years or so, sometimes less, sometimes more, but every several decades, there's a big kind of change to the way the global monetary system works. Kind of how the foundation of money, especially international money, operates. And so basically, as a result of an intentional design choice back in the 70s, that we can refer to as the petrodollar system, where all oil pretty much in the world is priced in dollars. So every country in the world, needs dollars to buy oil. We've created the situation where the U.S., we've solidified ourselves as the global reserve currency for a number of decades, and that's had some benefits. But ironically, one of the big downsides is that our currency is always, the on purchasing power parity basis, it's generally overvalued because there's kind of that global demand for it. But then that kind of shoots ourselves in the foot because it makes our exports less competitive. And we basically are forced to supply the rest of the world with dollars because we've kind of set up a system where they need dollars to get oil. and most other commodities. And so we've made the rest of our manufacturing base, the rest of our export base, rather uncompetitive. And so, if you look at where the U.S. economy does very well, we do great in software, we do great in financial services, we do great in healthcare, and those are generally high margin, businesses. But we're very bad at, for example, making cars that a lot of international markets want to buy. With the exception of Tesla more recently. But if you look at, say, Japanese and German auto manufacturing versus U.S. auto manufacturing, and kind of other sort of industries like that, that's where we've lagged. And so one of the risks there is you're more likely to get, rising wealth inequality, or concentration, I should say. So, for example, if you look at wealth concentration in most European countries and Japan, they haven't really had, to the same extent that we've had in the United States, because we've hollowed out a lot of our blue collar work to the extent that those countries haven't. And so the big risk there is that you get rising, populism, which, it's present in different places in the world, but to different degrees. So, for example, Japanese populism is pretty low. European populism is a little bit higher because they have some issues, with the structure of their euro. And then U.S. populism lately has been even higher, and it's in many ways a function of wealth concentration.
Mhm. So we look at the last sort of, since COVID started, the last time I checked anyways, M2, I think, was up over 25%. Probably more stimulus coming. Do you think that any of this is gonna actually lead to any real, increases in productivity, or is this just gonna be sort of a short-lived, blip in inflation like, Powell suggests? How do you forecast the economy looking as we come back online?
It depends on what time frame you look at. And so, the short answer is that, this emphasis on fiscal spending has not really been about productivity. It's been about kind of combating insolvency. And so, when you have kind of, all these incomes get shut down while people still have debts, that's when you get kind of these insolvency events. And so they basically, threw money into the system, increased the amount of money in the system, which has a tendency to be inflationary, and then it kind of, reduces the value of that debt in real terms. And that's kind of what we've seen over the past year, and it's been a boon for asset prices. I think that is likely to run into some headwinds, because the rate of change of the money supply, I think, is not going to be able to keep up at the same pace that it has. Now we'll see what happens with the infrastructure spending. It's possible that could lead to more productivity. For example, if you look back at say the interstate highway system put into place under Eisenhower, that was obviously an example of really productive spending. Whereas if you were to do things like increase internet speeds, fix some of the infrastructure, that could lead to higher productivity. But there are other types of spending that don't necessarily lead to higher productivity. And one of the things we can focus on is also productivity from technology. And so if you look back over the last 150 years, which is the longest data set I have for broad money supply growth, there were certain periods in time where broad money supply could grow a lot and not really be inflationary. And that's usually associated with periods of kind of, newfound technology. So, for example, in the late 1800s, you had that situation, because it was the oil age, right? So we kind of shifted our energy source to a much more dense form of energy, and so that was a huge boost of productivity. You also got another one around World War II, because you had all these new technologies come online. And then since the 90s and 2000s, we've been in kind of another period of productivity growth, because we've kind of turned everything into software. We've condensed multiple different devices into just our phone, essentially. And so we've had this kind of spurt of productivity growth, along with the fact that we've offshored our supply chains to cheaper markets, which, going back to the earlier point, is great for people that weren't impacted by it, but is really negative for people who lost their jobs to it. And so, one of the key risks is that, if we kind of get as far as we're going to get, with these current rounds of technology innovation and offshoring, and they start growing money supply a lot, that's when we could find ourselves with some more inflationary potential if we look out over the 2020s decade.
So, I know that you're not a politician or anything, but, when we talk about technology deflation, one event that I think we can kind of all sort of see, upcoming, that's kind of scary economically, is autonomous driving. And if that ever happens, that's probably gonna result in, quite a bit of job loss. If, you are a politician or a central banker, is there any sort of way that government, in your opinion, can sort of help navigate those transitions through policy?
It depends how far out you want to look and how kind of sci-fi you want to get. I mean, you can imagine a future with so much technology that the percentage of people that have to work is low, and then you have a problem. And so basically, if technology can replace, the type of work that 60% of people can do, that's an issue. And so if you look back in previous technology, it would displace some type of jobs, but then open up new types of jobs, right? So, people used to, most of labor used to be farming, but as we got better and better technology, we were able to take people off the farms. They were able to specialize more. They were able to go into manufacturing, and then we started, kind of taking that away. You get into more service-oriented jobs. And now the big risk comes if say AI and automation gets so good that say half the population just doesn't have a skill set that can outperform robots in almost anything. That's where you kind of get pretty big changes to society, and that's where you get politics, right? Because that's kind of prone to centralization, right? If a lot of people are not able to make their own living and are relying on external sources, and so that's where you get that issue. And so you could have basically ways to if you have a lot of technology kind of in the hands of few people, that's when you get those more redistributive policies. Instead of having say the first trillionaire, they might they might push back on that and say we're going to do a wealth tax above certain levels and distribute that technology, or distribute the gains from that technology. But that's where you get into really challenging you know politics to navigate, right? Because you have that the different ideologies, and very hard to agree when you have such big impacts on the economy. But when you look at autonomous driving, for example, I think it's going to come in phases where at first there might be a case where say a truck driver could drive, say mostly just has to be in there in case, right? So he's still getting paid. It's just he's less active at the wheel. Then you could have a situation where you have, say, a chain of trucks where there's like one driver and then there's like an autonomous truck following him that's mostly driving itself, and then but he's still around to kind of oversee this like almost train of trucks. Similarly, you could have same thing sort of happened with Uber drivers where the cars start driving themselves, but there's still, a driver on board. But then as you push out further and further, if you get to just complete self-driving, that's an issue because that's a very large percentage of jobs. And, some of them could be retrained, but over time, that's a huge political challenge.
Okay, so you, in terms of how you position yourself as an investor, you're primarily sort of taking more of a macro look. Would that be sort of fair, where you're kind of looking at sort of asset classes and like commodities, sort of Bitcoin, gold? Do you invest in any tech or anything like that?
Yeah, so my initial approach years ago was really equity focused, but because we're in such a macro heavy decade, there's so much going on fiscally. There's so much going on with these, with the amount of debt in the system, kind of the different structural forces that I've incorporated a macro overlay to my individual stock assessment. And so I do pick out individual equities, including some technology names and some value-oriented names. But then I have that macro overlay to kind of point me towards what sectors that I think are likely to benefit, or what other kind of diversifying asset classes, whether it's gold, whether it's Bitcoin, whether it's real estate, compared, to help with that equity basket, and also to look at what's the bond market doing, how are equities valued compared to bonds, and to kind of just see where the pools of capital are in the system.
Okay, so that's interesting because I've watched a lot of your content. And I've never thought of you as sort of a stock picker. I've always viewed you as more of a top down approach. I'm curious. I have to ask, what is your approach to when you're looking at something from a bottom up perspective? What are the kind of equities that you generally would gravitate towards?
I focus a lot on the growth at a reasonable price space. And so, there are people that specialize in, say, unprofitable growth stocks. There are people that specialize in super deep value, like really junky businesses, but that are so oversold that they almost have to go up. And my sweet spot tends to be in kind of the growth at a reasonable price area. And so, I've been in, a handful of technology and software companies that have done very well over the past several years. I also look at, kind of the moderate value section. So things that are cheap and cyclical, but that still are, say, leaders in their space that have, a degree of long-term compounding and staying power, to kind of minimize the amount of turnover I have to do if you kind of go into lower quality companies. And so that could be, commodity producers, that could be certain financial companies, that could be industrials. And so I kind of have that approach where I analyze different metrics. I look at returns on invested capital. I look at balance sheet strength. I look at the quality and duration of the management, to find companies that are historically pretty good at creating kind of compounded growth over the long run. And
Do,
and
do,
and then I look at valuations as well.
do you do the like sit down with management and try to understand sort of how they operate, or what's your thoughts on that?
So I don't, because mine, again, it goes back to that where it's the macro combined with the bottom up. And so if a firm is really focused on that bottom up analysis, they generally have fewer companies. They go talk to management more. Whereas me, what I find is generally that ETFs are imperfect, right? Because you're often you have a lot of kind of junk in there. You have a lot of quality in there. Sometimes you don't fully agree with the sorting mechanism for how those ETFs pick their equities. And so often what I'm trying to do with my individual stock analysis is basically maximize a certain theme. And so it's like, say I want to own commodity stocks, but I want to still have a look at what's going on down there. And so what one thing I find is that like there's kind of that silo where you have a lot of macro people that really focus on the macro, but they don't go down to see what individual companies are doing. And then you have the other side of the bottom up approach, where you focus a lot on the companies. And what I generally find is that when I take a macro approach and combine it with that bottom up approach, that can circle back and then inform my macro approach more. So I can go look at companies and say, what do their balance sheets actually look like? What are their CEOs saying in their quarterly earnings calls? What's going on down there, and that helps me kind of circle back up to make sure the macro is right, because you can have blind spots if you're just focusing on really high level information.
Okay. Yeah, that's definitely sort of what we do on our show, and what we try to focus on is we're more bottom up. So getting to talk to people like yourself that understand the macro environment is really valuable to us. Um, so here in Canada, Tiff Macklem, our governor of our Bank of Canada, recently announced that he's going to start tapering bond purchases. They announced a quantitative easing program. I think back in was it March of 2020, they originally tried to give it a different name. I think it was large scale asset purchases, and then eventually the media just wouldn't stop until they finally just conceded, okay, it's quantitative easing. Do you think that we could see a move towards the Bank of Canada to maybe say, okay, like we're okay with our dollar being worth more? And what would be the risks to a country like Canada saying we're okay with having a more expensive dollar?
Yeah, so I mean, it depends on what segment you're looking at. Canada is generally, because you're focused on the energy sector, for a big portion of the public markets and exports. That can still do well regardless of what the Canadian dollar is doing. So overall, I don't view that as a huge risk for the economy, but it certainly can put downward pressure on some of the asset prices. And it also depends on what part of the curve they've focused their tapering on, because that can affect the yield curve, which could have a large effect on bank profitability, and then consequently the bank stock performance, which in Canada the bank stocks are a large portion of the broad indices, and so I think that's going to be a challenge for multiple countries as we look out into maybe end of this year, and then as we get into the next year, is that different countries are going to be trying to normalize some of their policy, and that can be a challenge based on if there's sufficient demand for their debt markets, and how kind of structurally impaired their fiscal situation is. And so in the United States, for example, we did far more fiscal spending than most other countries, and we kind of went into this with a larger fiscal deficit as a percentage of GDP than most other countries, and so that's actually kind of harder to normalize. Whereas some of the European countries had small deficits, some of them had surpluses, and so they kind of did less fiscal to begin with, so it's somewhat easier to normalize, and so there's kind of a spectrum across the board. where a lot of this QE, a lot of this fiscal spending has found its way into asset prices over the course of the past year. And when the rate of change starts to slow down, some of that euphoria could really start to come off the market. And so we have to kind of watch out as we look into quarter 3 and quarter 4 of this year, where this honeymoon period of kind of rapid balance sheet increases, rapid fiscal stimulus, reopening starts to kind of hit its plateau and be risky.
So, do you have any sort of metrics or variables when you wake up, you grab your coffee? I presume you're sitting down. You've got certain media that you're reading, certain metrics that you're looking at. What are those metrics, and what is that media?
I'm usually looking at the dollar index, just seeing how kind of the big currency moves are doing that morning, because that can tell you a lot about what sort of if I can already usually guess at that point what sort of equities or what sectors are kind of doing well that day compared to other sectors. A lot of times based on what currencies are doing. And so I look at that generally when the market opens. I scan a bunch of different companies to see more directly what sectors are doing, what asset classes are lagging. Whether it's certain equities, whether it's gold, whether it's Bitcoin, whether it's certain commodities, and just kind of checking to see how that's performing. And then I usually go look at rates as well. And so that's kind of my check over. But because my emphasis is longer term. I generally have a 3 to 5 year time horizon with my investments. I'm not the investor that's kind of trading very frequently, but I'm kind of checking for anomalies or things that are kind of surprising or large moves.
Do you have any sort of I guess we used to call them magazines, but now everything's online, like The Economist or any type of media that you tend to gravitate towards following economics?
Well, I mean, there's certainly subscriptions that provide you kind of world news that are important to follow, and so I look at the Wall Street Journal, I look at Bloomberg, and I look at Financial Times, different sources like that, because especially for global news or things that I'm kind of monitoring certain things with, say, the global monetary structure and kind of news that kind of touches on that. What's happening with China and Russia, what's happening with some of these different kind of macro areas, and so I find that helpful. But a lot of what I'm focused on is looking at what companies are doing, looking at I think one of the best sources of data is the St. Louis Federal Reserve. They have that big online data repository and charting, service. But then when I meet, sometimes I need information that's not there, so I have my other data sources that I go to. And so a lot of my work is kind of checking these longer term trends and kind of finding research areas that I want to focus on to look for, say shadows over the knowledge or areas that are not quite as clear, and to basically try to make them more and more clear.
Okay. I subscribe to, I think I have subscriptions with all three of those that you mentioned: Bloomberg, Financial Times, and what's the other one? Oh, Wall Street Journal, which I had to renew yesterday. Um, so let's close this interview out with, for our audience who they want to find out more about your content. Where are you primarily delivering your content right now?
So I'm at lynalden.com. That's where the bulk of my content is. I have a lot of free stuff. I have free newsletter, free articles. I also have a low cost research service. And then I'm also active on Twitter at Lyn Alden Contact.
Awesome. And for our audience, I absolutely recommend everything Lynn puts out. I'm a big follower, big fan. And I could tell you for our staff, it was a big thrill to have you on here. And we really appreciate you being generous with your time and coming on here and chatting with us.
No problem. Thanks so much for having me. Happy to be here.
Right. Thanks, Lynn.